So why accounts payable? Why do we have accounts payable? We have accounts payable because it helps us increase our cash flow. If we can buy something today and not have to pay for it till 30, 60 days, in the short run, we increase our cash flow. And that's money we can plow back in our business for whatever we need in the short run. Let's talk about downside of accounts payable. There is a cost to keeping accounts payable. For example, labor costs. And depending on the workflow, the cost might be higher or lower. Where you have an inefficient workflow where you're always late, the cost of maintaining accounts payable is higher because now you have to call, you have to increase the amount of time you call just to find out what your bill should be. And then there's, let's say you don't use a lot of labor costs and you just use automation tools or app. There's a cost to that. You have to pay a monthly fee. Guaranteed the fee is less, but it's still a cost. And then when you don't pay your accounts payable as they come, as you receive your bill, there's the higher possibilities of late payments, because you could just put the bill someplace and forget it's there. And then when you get a reminder, you're like, and then with the late payment fee, then you remember and they're like, oh, I forgot. And then let's not talk about the loss of early payment discounts. Some vendors do offer early payment discounts when you pay early. So if you don't pay on time, you lose that. And then there's the supplies expense to pay your bills, like envelopes and stamps, if your payments are not automated. So labor cost depends on your accounts payable workflow. When your payments are automated, this is the least costly option. However, this is great for recurring payments. So if you have a bill that every month it's the same amount, just put in an automation because it just makes life easier for you. It's just less management for you. The payment is withdrawn every month without intervention from you. However, be very careful about making payments for services you no longer use. That's the problem I see with automated payments is sometimes you put things in autopilot and you're not using that service anymore, but you just keep paying for it because it's automated. So another workflow is actually paying the bill when it's received. So you receive the bill, you write the check, a supervisor approves and signs the check, and then you mail and file the check. So you're not stacking up accounts payable. You just basically, as the bill, you receive the bill, you just pay it, and you don't have to think about it again. So let's talk about the process of maintaining accounts payable. Okay, so you receive the bill, it's entered in the accounting program, another step. Monitor the agent's schedule, write checks as they come due, supervisor approves, and mail and file. As you can see, the more steps there are, the more hours you have to pay someone to maintain that account. And that's where the increased cost comes in. I'm not even talking about matching purchase orders with actual ones delivered to you. I'm just talking about the workflow of actually receiving from when you receive the bill to when you pay it and file it away. So now we understand the cost of maintaining accounts payable. Let's talk about the days payment outstanding. What is that? The days payable outstanding, also known as DPO for short, computes the average number of days a business takes to pay its vendors. So for example, if you pay your vendors every day, 30 days, that's your days payment outstanding. It's 30 days. Every 30 days, you pay your vendors the bills due. Now let us take a look about how we compute the days payment outstanding. To do that, you will need what you call your balance sheet statement and your income statement. On your balance sheet statement, it's best to have 2 years because you want to have an average because this smooths out the difference, the variations. So here we have 2 years here showing here. So we see 56,000 for the current year and 74,000 for the prior year. So we get the average of these two numbers to get 65,000. Then we want to get our cost of sales from the income statement. So we go to our income statement, get the cost of sales or cost of goods sold, and here we see that's 1,281,000. So we take that amount and then we divide 65,000, which is the average accounts payable by the cost of sales, which is 1,281,000 to give us the 0.05. So that's how many times in the year, like how often we pay our accounts payable in the year. Well, however, it's easier if we compute that number of days. So to get that, we multiply the 0.05 by 365 to give us 18.52 days. So that means every 18.5 days, we're paying off our accounts payable. So let's see what days payable outstanding means. To really understand what it means, you really need to put in context of your operating cycle and also your working capital needs. So right now we're just going to focus on the operating cycle, and then the next topic will be focused on the working capital. So we talked about operating cycle being the days inventory outstanding, the days sales outstanding, less our days payable outstanding. So in other words, how much days it takes you to turn over your inventory, how many days it takes you to turn over your sales, like sell it and get the cash, and how many days it takes for you to pay your vendors, after you've bought the inventory. So we add the days inventory outstanding to the days sales outstanding and subtract the days payable outstanding. So we have 100 days. So basically it takes 100 days for our cash to come back to us. So this could be a financing gap, as we talked about previously, because that might be we have 100 days which before we actually get our cash. So we might need to financing just to close that gap, but that's not always the case, because sometimes you have a margin big enough to cover that gap. And if your margin is big enough, then normally you'll be good. But if it's not, then you need some other kind of financing to cover the days in which you're not collecting on time. So also we see the effect of increasing. In the case of days payable outstanding, we want to increase it, because here we see there's an opportunity here, because more than likely most vendors give business people 30 days to pay. So more than likely this vendor has 30 days to pay. So they can actually decrease their operating cycle by increasing their days payable outstanding. So here we see the increase it by 80%, that they can get as much as a 15% decrease in the operating cycle. So this might be something I might want to look at. Obviously, there are other costs to holding up accounts payable, so you want to think about that too. But I mean, that's definitely something to think about in your business. If you need to talk to your vendor, if there's not enough cash, whatever it is, but these are things you want to think about and analyze, rather than just waiting for the wind to push you wherever. You can sit down and plan and actually have control of the situation. So let's see how days payable outstanding affects cash flow, because without understanding how this whole thing works together, how it affects cash flow, I mean, the equation, the ratio really doesn't really have much meaning. So to do that, let's just scroll directly down to the agent schedule. So here in the workbook, we down to the agent schedule. Cash collection for the period was 2,047,000. Well, we had a 19 days payable outstanding. So which means in the current period, accounts payable will come due. So that's 1,331,820 we have to pay in the current period. Luckily, we have enough cash sales to cover it. So here we're fine. But what happens if, let's say for instance, we only collected 50% of cash? And so what happens? Well, here we don't even have enough cash to cover our payables in the current period. So we have to look for some kind of external funding. And the bad part about your accounts payable being due in the current period is sometimes you might not even have time to get funding. So then you're going to make your vendors mad, because you're going to have late payments and late fees, which increases your cost of accounts payable. So what happens if accounts payable number of days is increased by 30 days? Well, now we don't have to pay to 3160 days, which gives us additional time to get more funding, or we can go pester our customers to pay us, because now we know our payments are coming due. And so what we can do in that case, we can reduce our accounts receivable number of days, and because we know we're going to have to pay, because when we see the schedule, we can plan, and we're not going to allow customers to pay us in 83 days like we've been doing. So if we collect all our receivables in the current period, it gives us enough time in 31 to 60 days to pay our payables. So this is the importance of the schedule, to seeing how it affects the cash flow, is because you want to know how the cash is going to move, where you're going to get the cash from to pay your vendors. If you need external financing, you really need to sit down and think about it, rather than just letting the wind of circumstance blow you everywhere it wants to. Once you know your payment schedule, you can use credit cards or working capital loans to extend the day payment outstanding. However, be very careful that you do not use this means to fund slow-moving inventory of bad business decisions. This is not a free for all money. This is money you actually have to pay back. So before you borrow this money, you need to sit down and figure out exactly how you're going to pay it and when. Because if you don't sit down and figure this out, this could put you in a worse place than you started. If you really want to delve deeply into your business and get very good insight, I recommend you get the workbook and exercises by clicking on the link below. In this exercise and workbook, we delve very deep into your business to see what the numbers in your business really mean. Because sometimes, as business owners, we run our business and we don't really understand what our financial actually are telling us or what changes we need to make. With the workbook and exercises, you'll be able to really delving into what is making you profitable, why, what do I need to change, and my policies make sense. They make sense for my specific business. And not only that, you get internal process analysis, like what areas in your business are you spending too much, or where can costs be delivered at less cost? Where can processes be delivered at less cost? Using the information from 1 and 2, you can use that and create a 5-year budget so you can actually start being on track to direct your business rather than letting the wind blow you wherever the business takes you. So you're being proactive rather than being reactive.